Muito bem, agora com grande alegria nós temos aqui o nosso governador William Dudley, que foi presidente do Fed de Nova York. Como tal, ele obviamente tinha todo o sistema financeiro, né? O Fed de Nova York tem um papel especial de acompanhar o sistema financeiro, inclusive o sistema financeiro internacional. Ele foi do Fed desde 2009 e passou vários mandatos, tá certo? Então ele conhece muito bem da política monetária, das implicações para os bancos, e ele tem feito um trabalho também magnífico em relação ao futuro do sistema bancário, a toda digitalização. Hoje de manhã a gente ouviu o nosso presidente do Banco Central falando sobre digitalização do setor financeiro. Ele, hoje em dia, é um dos maiores especialistas. Mas a gente vai falar muito mais de política monetária. Então, sem mais, eu vou aqui. I have just introduced you, and we are so glad to have you here. It's a great moment for our conference. It's really, it's not a speech, it's even more than that, but you're the keynote interviewee. Okay. I think to have a few questions, and then we're going to open to the audience to make their own questions. You have the carry code, and if you use the carry code, you could send us questions, and you'll be glad to pass to Bill. Okay, so I think that the whole world followed with a lot of attention and even a bit of trepidation what happened last week with the Fed. Like you mentioned yesterday, it was not so usual situation, because usually the Fed telegraphs what is its intention. We got some information, but in a very unusual channel. This fellow from the Wall Street Journal kind of got some, but I don't consider this Fed communication, real Fed communication, right? So in this sense, there was an element of surprise on the decision. But the fact is that we had this 0.5% cut. So let's start asking, what do you think were the main drivers for this cut, and why this size?
So why did the Fed cut 50 basis points? Well, I think the best way of explaining it is Chair Powell determined that the inflation problem was mostly under control. The inflation had come down quite a bit, still running 2.5%, but I think his view is highly confident now that it's going to get down to the Fed's 2% objective. And that was always the mantra that he used. Once I'm highly confident that we're going to get to the 2% objective, then I can start to reduce rates. Second thing going on is the labor market in the U.S. has started to loosen. We've had a bunch of different labor market indicators that suggest that the labor market's softer than it was even just a few months ago. First piece of information was that payroll employment growth over the past year ending in March was much weaker than we thought. There was a big downward revision. Powell talked about that in the press conference. Second piece is the number of unfilled jobs to unemployed workers has come down. That ratio, unfilled jobs to unemployed workers, peaked at 2 to 1. Now it's 1 to 1. That's less than the level we had before we had the pandemic. Third piece, unemployment rate has drifted up. And fourth piece, the 3-month change in payroll employment, last 3 months, the lowest 3-month change in payroll employment since 2020. So less risk on inflation, or more progress towards the Fed's 2% inflation objective, more worries on the labor market. Basically, the two dual mandate objectives of the Fed, 2% inflation, maximum sustainable employment consistent with 2% inflation, those two goals now in balance. Now, if the two goals are in balance, that means monetary policy should be neutral. But monetary policy is not neutral. It's actually tight. And so, end of the day, I think Chair Powell decided that given how far away from neutral they are, maybe we need to get going with a little bit greater eagerness than what people thought. Now, in terms of the uncertainty going into the meeting, I think what happened was Fed officials were of different minds about whether it should be 25 or 50. And going into the meeting, a week before the meeting, the market was sort of the view that it was going to be 25 basis points. And Powell didn't really want the conversation to be closed off at that point. He wanted to be able to have a discussion about why it should be 50. And so they had a conversation with Nick Timros of the Wall Street Journal, and they had a conversation with Colby Smith of the Financial Times on the same day. Both articles basically said, hey, wait a minute, it's still an open question whether it's 25 or 50, and then we got the 50 basis points. We can be pretty comfortable that this was Powell's decision, because when they published the summary of economic projections after the meeting, there's a so-called dot plot, which shows what people think interest rates are going to do through the end of the year and then 2025 and 2026. 9 people had only one more 25 basis point rate cut in 2024. It doesn't make sense to go for 50 and then just one more 25 basis point rate cut. The only thing that makes sense for those people is they wanted to go 25, 25, 25. So I think Powell carried the day. There was only one dissent, Michelle Bowman, who's on the Board of Governors. First dissent, I think, since 2005 or 2006, so pretty unusual. But Powell got his way, and I think the reason he got his way is the logic is actually very compelling. I've been in the 50 basis point camp for some time in terms of what I would do, but it took me quite a while to get to the point of this is what they are going to do. The Colby Smith article and the Nick Timros articles pushed me over to the right side. And so when the meeting occurred and they did 50 basis points, I had a little sigh of relief because I was on the right side.
Yeah, it should be remarked that you had the right call just before the decision. And now you tell us the thought process for that. Now, there's one thing that people don't pay that much attention, but maybe because of my training, we do watch how the fiscal impulse has been in the U.S. In 2022, it was quite contractionary, negative. Then in 23, it was a bit expansionary and may have helped the consumption to grow for a longer time. But then in 2024, it has been quite contractionary. The fiscal, the primary deficit has been cut by half. How much do you think these changes in the primary deficit and the fiscal stance can affect consumption, activity, and ultimately even the inflation?
Well, certainly the impulse from fiscal policy, can contribute to either higher demand or weaker demand. And I think you're right that the impulse of the fiscal stimulus that was very, very powerful during the latter stages of the Trump administration during the pandemic. And then when Joe Biden passed the $1.9 trillion fiscal package early in his administration, that was also augmented by a number of other fiscal initiatives, infrastructure spending bill, the CHIPS Act to build big new semiconductor plants. I think it's really hard to evaluate exactly where we are in the fiscal impulse, though, because some of these monies have not fully been spent. So it takes, 5 years to build a CHIPS plant. So you pass the legislation, you have the money available, but then it actually takes time for that money to be spent. I would guess, if you look at the Brookings Institute, which is a very, middle-of-the-road think tank in the U.S., has a fiscal impulse thing that they produce and track. And I would argue, fiscal policy is probably slightly restrictive, but not quite as restrictive as the primary change in the primary deficit might suggest. It's true that the primary deficit is better, but the overall deficit is unchanged. This is probably one big problem in the U.S. that doesn't get enough attention, that the U.S. is still on an unsustainable fiscal path. The budget deficit this year is going to be over 6% of GDP, and the Congressional Budget Office, which basically evaluates what the outlook for the budget is over the next decade, sees no improvement, 6% of GDP as far as the eye can see. Moreover, the Congressional Budget Office estimates are actually optimistic because they assume the 2017 tax cuts to individual income taxes and to corporate taxes will expire at the end of 2024, and in fact, that's actually highly unlikely. They also assume no recession over the next 10 years, probably not going to occur. So 6% of GDP or worse is the track we're on. Now, so far, this is not part of the political discussion in the United States. In fact, if anything, you hear Trump and Harris trying to one-up each other in terms of handing out things to the electorate. Recently, Donald Trump said that he was going to exempt overtime pay from income taxes. Now, I mean, that's a little bit crazy, right? That a certain component of your income gets exempt from income taxes, but not other components. I mean, some people don't get paid overtime, so I guess they lose out. We're not in a serious situation in the U.S. in terms of addressing our budget deficit. And economists like me and think tanks like the Peterson Institute, we wring our hands. But nothing's going to happen, frankly, until markets finally balk and say, this is not sustainable. So, they always say that the end comes slowly, but when the end comes, it comes all at once. This is what's going to happen in terms of the U.S. budget deficits. It's not a problem today. It's probably not going to be a problem tomorrow. But at some point, markets are going to start to balk at the fact that this is getting not addressed. And when that happens, bond yields will go up, interest costs on the debt will go up, and the whole situation will get worse. And then the political pressure on the politicians will increase because voters will start to say, well, hey, why are mortgage rates so high? And then the calculus will turn. The last time the bond market vigilantes were out in force in the United States was 1994. Bill Clinton was president. What did Bill Clinton do because bond yields were so high? He tightened fiscal policy. Not because that was part of his platform, but because he thought that was the best way to encourage a healthy economy. So I think it's going to happen that way. At some point, the markets are going to say, no mas, and then at that point, you'll actually see a political response. But so far, no support on either side of the aisle for fiscal consolidation.
Okay, you're going to, yeah, that's true. Now you talked about that. Among the things that you've been watching and kind of foreshadowed the slowdown of the U.S. economy, in addition to the slight contraction, was credit, particular to households. If you look at even the level of credit in the last quarters, actually, in real terms, have clearly declined. How do you see credit to households, also non-performing loans and the situation, the ability to serve debts of households? How serious is that?
So I would say that generally the household sector is actually in pretty good shape from a balance sheet perspective at this stage of the business cycle. Usually at this stage of the business cycle, the household sector is way over their skis. They borrow too much money and they need to consolidate. But I don't think that's the case this time. I think what instead we have is a tale of two cities, a tale of two groups. High-income people are fine. They're the ones that are benefiting this soaring stock market. Their pension funds are doing very well. Their retirement savings are doing very well. It's the low and moderate income households that live paycheck to paycheck that are suffering because they don't have the financial assets that get a benefit of higher financial asset prices. And they're the ones who actually pay the higher short-term interest rates on their car loans and on their credit cards. I mean, high-income people in the U.S. don't actually have a lot of credit card debt. They use their credit cards. They pay off their balance at the end of the month. They get reward miles for their spending, and the credit card really costs them nothing. Low and moderate income households that use credit cards, they run a accumulating balance that they roll over every month, and the interest rate they pay on that credit card debt is usually in the 20 to 30% range, so it's pretty steep in terms of the burden on them. We see the stress on low-income households. Number of companies that are servicing that constituency have reported weakness. Dollar General, which is a convenience store, small towns, weakness. McDonald's, weak sales. So places that are sort of oriented towards the low and moderate income households, you can definitely see signs of stress. What's happened there also is that people basically spent the money that they got during the pandemic. There were large fiscal transfers. Even with the last Joe Biden, the 1.9 trillion, they sent out checks to everybody below a certain income level, whether you actually had a job or not. So everybody got a check. So that actually boosted savings, and that allowed you to sustain consumption for a while. But for most households, that money has been spent.
And yes, what about corporates? Because they also are not that exposed to interest rate these days. They don't have a big debt. Well, some benefit indirectly from the increase of the stock market. It's remarkable that the stock market, the increase in wealth was equivalent to about 20-25% of GDP. So like you said, for the high net worth households, it's an easy time. For those not. But what about the corporations? Some people say that, well, look, sometime some of these hidden liabilities will appear and you may see a crop of really weak company, even crops, I don't know, emerging.
Well, I would say a couple of things on the corporate sector. I think the first thing to recognize, again, haves and have-nots. If you're a big corporation, you've termed out your funding, you have very low long-term debt that's not going to come due for many years. You've locked in your costs. You're not really that affected by what's happening to short-term rates. But if you're a small business borrower who's borrowing from a bank, you're borrowing, at the prime. It's a floating rate typically, or if you've termed it out, it's just 2 or 3 years, and that debt is rolling over at higher interest rates. So again, large corporations pretty well insulated, smaller companies under a lot more pressure. So that's probably again one reason why we're seeing some signs of stress in the corporate sector, but it's not pervasive.
Now, look, we look at the households, we look at the corporates, maybe the third sector in the economy is the financial sectors. And I mean, it's starting with the Fed. They got a lot of red ink in the last few quarters. How is is this a problem that the Fed got red ink? And also, in what shape is the financial sector in the US?
So let's start with the Fed, and then we'll talk about the financial sector. What Kim is referring to is the consequences of quantitative easing on the Federal Reserve's earnings. So the Federal Reserve bought trillions and trillions of dollars of long-term mortgages and long-term Treasury securities, and they did that because they're trying to basically provide additional monetary policy stimulus when interest rates were at zero. So there's like, okay, we can't cut interest rates anymore. How can we provide additional monetary policy stimulus? Let's buy long-term fixed income assets. That's great, and that did provide more stimulus. But what happened when the Federal Reserve raised short-term interest rates, the cost of their liabilities, basically reserves plus currency is, they don't have to pay anything on currency, but reserves became a bigger and bigger proportion of their liabilities. And the cost of reserves is tied to the interest rates that the Fed sets. That's what the monetary policy decision is. The Federal Reserve sets the federal funds rate. So now, 4.5 to 4 3/4, or 4 3/4 to 5%, sorry. And then they set the interest rate on reserves to make that so. So the Federal Reserve now has it's like a giant savings and loan with lots of long-term assets, but a lot of short-term liabilities. So they're losing a lot of money. So far, the Fed has lost about $200 billion in terms of loss that's shown on their balance sheet. You can go on to their what's called the H41 release, and if you look at Table 6, every week you can see how the Fed's losses are creeping up. The losses are actually bigger than that because if the Fed hadn't done quantitative easing at all, they still would have made money because they'd be funding the assets with currency, and so they'd be earning a net positive spread. So the total cost is probably about $500 billion. And what's interesting about it, not an issue at all. Never comes up in the press conferences, never comes up in Congress. It's sort of remarkable that you lost $500 billion and no one asked the question, was it worth it? So what I've been
sort of arguing for is that when the Fed does its monetary policy framework review this year into next year, that maybe developing a little bit more formal structure about QE and QT to do a little bit more formal cost-benefit analysis rather than just benefit analysis to figure out, like, when do you stop? Because you could really argue, going back to 2021, 22, and that the Fed Reserve could have stopped quantitative easing much earlier without any negative effect on the economy. Because the economy didn't need more monetary policy accommodation. What it needed was the end of the pandemic. Once the pandemic ended, the economy came bouncing back, so it wasn't like you needed more monetary policy stimulus. And that last additional $1 trillion of quantitative easing costs the Fed a lot. So I'm hoping that maybe a little bit more careful cost, but they're not getting any flack at all for this. Second question you asked about is the state of the U.S. financial sector. I think it's actually quite good for two reasons. Number one, we had the great financial crisis, and that was horrible, but it was like a violent forest fire burning all the tinder in the forest, sweeping away all the weak structures, the bad ideas, the things that could not withstand stress. And fortunately, we haven't built a lot of new stuff like that. So the system is more secure just because you swept away a lot of the weak stuff. The second thing that happened following the great financial crisis is we made the financial system a lot sturdier. Banks, more capital, better quality capital, liquidity requirements, stress testing, tougher supervision. Banking system is a lot stronger now because of that. The second thing we did is we fixed a lot of the plumbing. So one of the things we did after the great financial crisis is we basically said, over-the-counter derivatives, we can't just have them be bilateral obligations between two companies. We need to have them centrally cleared so we can net down that risk. So the G20 instructed the FSB to get that done. And so now the vast bulk of over-the-counter derivatives are centrally cleared, which has reduced the risk in the system tremendously. We also then spent a lot of time trying to make financial market utilities, where all this stuff gets settled, a lot sturdier. And even during the very stressful events of the COVID pandemic, the financial market utilities came through with flying colors. So the core system is a lot stronger than it was. So what do I worry about? What does everybody worry about? They worry about the non-bank financial sector. And they worry about it for two reasons. One, it's grown very rapidly over the last 15, 20 years, and it continues to grow very rapidly. And two, we really can't see very well into it. Just one example of how we can't see into it. Archegos. Archegos was a hedge fund. They bought a handful of stocks, and they bought them again, and they bought them again, and they bought them again. And obviously, if you buy a lot of stocks in a short period of time, what are you going to do? You're going to push the price up. They borrowed against the stocks to buy more stocks. And the prime brokerage firms that were lending to them had no idea how big they were. Each prime brokerage thought that they were by far the leading counterpart of Archegos, and it turned out they weren't. So it turned out to be a house of cards, a bubble, and when Archegos had to start to liquidate, prices fell, and that was the end of the story. All because you didn't have enough transparency. If Archegos had been forced to disclose the total size of its positions, it never would have gotten that big, and therefore you would never have the financial stress you had when they unwind those positions. So, I think it'd be great to have a little bit more transparency in terms of what's happening in the non-bank sector. But it's hard to coordinate internationally.
Yeah. Well, in Brazil, there's a lot of disclosure, and even before 2007, there was a central clearinghouse where you knew all the derivative exposure of institutions, and that helped us very, very much at that time. I think you actually already answered some of the questions that I received, including about the QE and if it was necessary such a big QE, especially in 21. But I have maybe a more academic question, but I think it's a very hot question, especially when we look forward, with the following. If you look not only the US, but also Europe, and even a little bit of Brazil, we've seen a lot of disinflation despite very strong labor market. Of course, now we had a weakening labor market in the US, but I mean, you look at the chart of unemployment and it's really very small. Now, associate of mine, I mean, Mr. Yuki, often remarks that this is very unusual. We might wonder, is it an impact of China, that the missing consumer of China decreased the global demand, and also there was a lower PPI. But is there already some sort of idea how come this time you had such a strong disinflation with strong markets in the US, in Europe, even in Brazil?
So, going back a couple years ago, there was a big debate, right, between the people in the transitory inflation camp and the people in the not transitory inflation camp. And the transitory inflation people were basically saying inflation is going to come back to 2% pretty quickly as supply chains normalize and the demand for goods and services goes back to where it was pre-pandemic. I mean, what caused a lot of stress in the system was that the pandemic caused people to buy a lot more goods and a lot less services. And so the system wasn't set up with just-in-time inventory management to supply those goods in real time. And so goods prices soared as a consequence and went back to where it was before, less goods demand, more services demand. And I think that took a lot of the upward pressure off of prices. Now, I don't think that was the complete source of the inflation pressure because in the United States, at least, we did have an overly tight labor market. And we know this because wage inflation peaked at over 5%. And 5% wage inflation is not consistent with 2% inflation. But then we were also bailed out by one very important thing. Despite the surge in inflation, inflation expectations stayed very well anchored. And so businesses basically said, yes, I see inflation's 5% right now, but I'm not going to pay you 6 or 7% wages. I'm going to pay you 5%. And so you never got into a bad feedback loop where inflation goes up, then wages go up, which pushes inflation up further, all because inflation expectations stayed well anchored. And that really, I think, was due to two factors. Number one, inflation in the United States has been very low for the last 20 years. So people sort of thought that the pandemic experience was unusual rather than usual. So they sort of thought, okay, I understand that this could be temporary and we can go back to the old regime. And second, I think the Fed did a very good job in communicating that we are not going to stop in terms of our monetary policy tightening regime until we're highly confident that we're going to get inflation back down to 2%. Powell said this over and over and over again. And in order to make the story sort of more real to people, he basically said, I don't want to make the mistakes of Arthur Burns. Arthur Burns was the Fed chairman in the mid to late 1970s. And Arthur Burns tightened monetary policy, the US had recessions, but each time the trough in inflation was higher than the trough before, and we actually had a wage price spiral under Arthur Burns because he didn't finish the job. Now, in Arthur Burns' defense, he was a little unlucky. We had the first 1973 Israeli war. Oil prices went from $3 a barrel to $10 a barrel. Then we had the Iranian Revolution, and oil prices went to $10 to $30 a barrel, and they didn't go back down. All the price shocks that we got during the pandemic, prices went up and came right back down. Arthur Burns didn't have that good fortune. So Powell was very, I think, a good communicator, a consistent communicator about why he was going to get the job done. And people asked me, do you believe him? And I said, well, of course he has to say this because you obviously can't say the opposite. I'm not going to get the job done. I'm going to let inflation surge. But I think he did it with such regularity and discipline that actually made the job easier. If the Fed has credibility, any central bank has credibility on inflation, it makes the job much simpler.
Okay, well, You mentioned the 73 war. Some people asked about risks of war, and I mean, if you're looking forward, what do you think might be the biggest risks of inflation coming up again? And would war be one of these?
So yeah, I mean, there's two big risks of inflation I see in the very near term. First risk is, as you mentioned, much broader Middle East war. And I'm amazed how relaxed financial markets seem to be about this, because the fighting between Hezbollah and Israel along the Lebanese border has gone up a lot, and we don't really know where Iran is going to stand in terms of what's happening to their proxy, Hezbollah, that's getting decimated by these attacks. So I do think there's a risk of a broader war. I mean, I think that there's a lot of people that are trying to dial down the temperature, certainly the U.S. I think in some fundamental way, Hezbollah and Iran don't really want to have a big war. But, you know, if you are provoked sufficiently, you know, politically, that it becomes very hard to hold back. You know, my own personal view is that Netanyahu is the real problem here, because he stays in power as long as the war goes on. And, you know, the Biden administration has been trying to, you know, convince him that this is not the right approach. But the leverage the U.S. has is very little, because the U.S. is just not going to let Israel go. This has been a long-standing commitment. And so the U.S. is, you know, going to continue to support Israel, even as the U.S. is very unhappy about how Israel has prosecuted the war. I mean, this is a big issue in the U.S. election in terms of the number of innocent Palestinian children, women, civilians have been killed in this war. And this is something that bothers people a lot about how Israel has prosecuted the war. So it's a real issue.
What about Ukraine?
So that's the first issue that I would worry. The second issue I worry about is the election outcome. We haven't talked about that. So candidate Trump has proposed to raise tariffs 10 to 20% across the board, 60% with China. Yesterday he said that if the Deer Farm implement production company moves to a plant to Mexico, he'll put a 200% tariff on their production from Mexico. Tariffs are going to go up significantly if Donald Trump is president. Now, I say that with confidence. You might say, why would you have confidence about anything that Donald Trump says? And I think that's a fair point, that what Donald Trump says today is not necessarily what he's going to say tomorrow or what he's actually going to enact into policy. But the tariffs is something that he's been very, very consistent on, number one. It's something that he did during the first term and he thought had positive rather than negative results. And it's something that the president can do without a congressional approval. So this is something that I actually do think Trump would do if he were to take office. And these tariffs are going to cause a mess. Two things are going to happen if you have dramatically higher tariffs in there. Well, three things. Number one, you're going to have more inflation because tariffs go up. Number two, you're going to have less productivity growth because it's going to totally change relative prices in the U.S. in terms of where you want to source your inputs into your final goods, where you can export, where you can import from, at what cost. So big productivity consequence. So it'll be a mess. Third, people are going to retaliate against the U.S. It's not like we just put the tariffs on there, everyone goes, oh, that's nice. They're going to retaliate against U.S. exports, and so there'll be a knock-on effect. So, my own personal view is that the Trump policies would be terrible, not just for the U.S., but for global trade, the global trading system, and would also create a lot of uncertainty about how things actually evolve. So my view is Trump, bad policies, a lot more uncertainty. Harris, policies are, they're all right. I mean, I think she's probably a little bit more inclined to fiscal stimulus than I would be at this point in the cycle. But I think, with Harris, it's sort of going to be like Biden. You sort of know what you're going to get. And so, I think Biden, from a markets perspective, from an economic performance perspective, from a Fed's independence perspective, that's who you want to vote for if you're thinking about what's best for financial markets. And I think if you think of what's best for the global financial system, global cooperation and coordination, all the things that the Bretton Woods Committee, which I'm the chair of, stands for, of course you're going to want a Harris win rather than a Trump win. Election is also not priced into the markets. And there's really sort of three possible results. One result is Trump wins. Trump wins, bad for all the reasons I just told you, but it won't, the Democrats will honor the election outcome. There won't be a lot of uncertainty, and there won't be riots, and it'll be a lot of unhappiness. There'll be a lot of people talking about where can I move, but life will go on. Trump, if Kamala Harris wins narrowly, it's going to be a mess because the Trump supporters will not accept that outcome, and Trump will litigate that result in the courts. So there'll be days, weeks, and months of uncertainty about how the election's actually going to turn out. And there actually could be violence. Third outcome, Harris wins by a lot. In that case, I think it's harder for the losing side to be as upset or to litigate successfully, and so life goes on. But boy, this is very, very tight. Right now, I would say Harris has a slight advantage. Basically what happens is Harris has improved in the polls in three increments. Number one, Harris, not Biden. Harris is younger, more dynamic, improvement in the polls. Democratic National Convention, Democrats unified, a lot of enthusiasm, Harris better in the polls. And then lastly, the Harris-Trump debate. Most of the pollsters that looked at it were 63-37% Harris to Trump. And you remember, that 37% that thinks Harris lost the debate, those are Trump diehard supporters that if Trump just sat there and slept during the debate, they would have thought Trump won the debate. So this is a whopping margin in the debate. Anybody that was sort of neutral on the Harris side thought Harris won the debate. So she's ahead in the polls by a very small margin. There's a market in the U.S. you can actually access called predictit.org, where basically it's an academic market where people make bets on the probability of winning the election. So you can actually track how these probabilities changed. At the low point, it was Trump, Biden 45-ish, Trump 55, and now it's roughly Harris 57% probability, and Trump 43% probability. So, still very up in the air. Harris is doing better, but, long way to go. It's all going to be about turnout. Can Trump turn out his base? Can Harris turn out women worried about reproductive rights? Can Harris turn out young people worried about gun violence, worried about climate change? The side that can turn out the most voters is going to win the election, and it's going to come down to a handful of states. The way the U.S. system is not winner-take-all based on the national poll. It's basically winner-take-all in individual states with a couple of exceptions, and then you add up all the states to see how many electoral votes you have. And so there's basically like 6 or 7 states that are in doubt, and that's where all the election is being fought out. Pennsylvania, Nevada, Arizona, North Carolina, Michigan. I probably left one out.
Yeah. Well, fascinating. We're heading to the end of our meeting, our conversation, but the financial landscape in the U.S. and everywhere is changing. And you mentioned when you were talking about the Fed balance sheet, the question of the value of the bonds in the asset side, and some people in the audience remarked that small and medium-sized banks in the U.S. had a lot of market-to-market, non-market-to-market. But the point is that because of just a Twitter on a Saturday morning, one bank went down. So we see changes in this case, we see changes in digitalization and so on. Is this a major risk? Is this a major source of gaining productivity? would AI change the financial landscape? There are so many questions about, from the audience about these things. If you could just guide us a little bit on that.
So let me break that into two questions. First, the state of the banking system and the events of March of 2023. So Silicon Valley Bank took on a lot of corporate deposits very, very rapidly and took the money and bought long-term treasuries and mortgage-backed securities. Not a good idea. The deposits were, essentially demand deposits. And so when interest rates went up, they had a lot of losses on their portfolio. Those losses were known. People started to worry about their capital base and their earnings, and people pulled their deposits out, and so you had to run extraordinarily rapidly. A number of other central banks at the same time got into trouble because they had a lot of commercial real estate exposure, and those banks are still under pressure, and they're working their way through their problem. The good news on commercial real estate is it's not commercial real estate writ large. It's really office buildings in central cities. And the good news is that all these commercial real estate loans don't come all up at the same time. They come up gradually over several years. The third positive is that this is all known. This is not, behind the curtain. And when you know what a problem is, you can sort of assess it and evaluate it, and the banks can respond by raising capital or finding merger partners. So it comes to a gradual end rather than a violent end. So my own view is that there'll probably be some individual regional banks in the U.S. that will have to raise more capital, find a merger partner. Some may fail, but I don't think it's systemic. And that's really what the conclusion is that financial markets have made. In terms of AI, boy, we could be here for another hour talking about AI. It's a huge wild card in terms of what's going to happen to productivity growth in the future, number one, and when is it going to occur? I am probably slightly on the skeptical side of AI in terms of what it's going to do. I mean, I think it's going to be good in a lot of different areas. I think it's going to be good for finding out information really quickly. I think it's going to be good for helping writing rough drafts. I think it's going to be helpful for writing manuals, for servicing customer inquiries. I think it's going to be great for medical diagnostics. But I think it's important to recognize when people say artificial intelligence, I don't think we're really quite yet at the intelligence stage. And the reason I say that is these AI models really don't learn from their mistakes. They're just playing back from the internet what they see based on a probabilistic assessment. This is why you get hallucinations, because it's a probabilistic 99% right. Well, it means there's 1% probability of being wrong. So that's why 1% of the time you have a hallucination. So I think we need it to be a little bit better system than that before we take it to the bank. My sort of proof of concept in terms of whether this will really be, the true next generation of AI, in my mind, is self-driving cars. Because it seems to me that's the appropriate test. Because what are self-driving cars about? They're about pattern recognition and responding to those pattern recognition in an intelligent way. So if you can get an AI program to the point that you can actually drive a car safely, then I think you've actually achieved a further level of technological sophistication that's really important. Because think about that. If you have self-driving cars, you can have self-driving trucks. You can change, how you actually move goods and services around. That's a pretty big innovation. So I'm waiting for the self-driving cars to actually be not just theoretical, but something that we actually see in the streets.
Okay, well, wonderful. You have a couple minutes left, and the last question, I'm going to ask a very broad one, which is, we see the monetary policy relaxation in the US. What could you expect to happen for emerging markets? I know emerging markets are very different among them and so on, but generally, between lower tax and maybe slow down the economy and so on and so forth, what will be your sense, and perhaps even for Brazil?
Well, I think that, generally, I mean, obviously, it's a function of what's happening in an individual country, and oftentimes that really depends on what's happening on the fiscal side. So, stimulative fiscal policies, then you're going to have more demand, and then the central bank's going to have to respond to this. But I think the Fed easing, and let's be clear, there's a lot more Fed easing to go. I mean, we haven't talked about where the Fed is headed, but most people think that neutral federal funds rate is probably sort of in the 3 to 3.5% range. And so right now we're at 4.75% to 5%. So there's still a long way to go just to get to neutral. And if the economy falters and the Fed feels that they have to make monetary policy easy, we could see a federal funds rate of 2 to 3%. And I think what this does is it takes a lot of the pressure off emerging markets and gives them a little bit more policy flexibility. Because one of the consequences we'll see as the Fed continues to cut rates is the dollar will tend to be on a weaker trajectory. Now, I don't know how much the dollar will weaken from here because a lot of easing's already priced in, but the dollar is not going to strengthen as long as the Fed is on an easing trajectory. And it seems to me that gives the emerging market economies another degree of freedom in terms of how they conduct policy. Another, advantage is it doesn't seem like the other big economies have a lot of forward momentum. I mean, Europe's not growing very rapidly. Germany in particular has a huge transition problem in terms of moving from internal combustion engine cars to EVs, where China is way ahead of everybody but Tesla. And China has its own set of problems with a property market bust that looks like it's going to continue for quite some time because the overhang of property there is really large, and the Chinese authorities are trying to figure out, so what avenue of fiscal stimulus is the most attractive avenue? And, historically what they've done is they've built more infrastructure, but it's not really clear that China needs more infrastructure. When I look at China, what I conclude is they need more consumption and less domestic savings, because what you see in China is a very, very high savings rate among households. And so what you want to do there is provide a better safety net in China so people feel more comfortable spending more of their income. That would seem to me the win-win for China. People would feel better off. They'd spend more money. The Chinese economy would be in better balance. That would be what I would pursue if I was Xi. I was going to say if I was king in China, I had to be Xi, right? But I'm not sure that they're going to do that. It seems more same. They seem to think that encouraging consumption is wasteful, but encouraging investment is productive because at least you end up with the investment. But right now you have a lot of emphasis. You have a lot of empty buildings in China, so I'm not sure that investment has been so productive.
Okay, well, that was just wonderful. I think that we got a pretty good view of what to expect in the next few months. And I think it's encouraging. We see, all the space for relaxation. Of course, there is the uncertainty of the election, but there are some possible, if not outstanding, but at least, say, comfortable outcomes. And,
This is why it's good to have our job. No matter what happens, things will change, and there'll be something else to commentate on in another month or two.
Exactly. So we're probably going to meet again sometime
After the election.
Exactly. Well, thank you so much. Thank you, everybody, for attending.
Thank you.
And congratulations.